Ladies and gentlemen, welcome to the Motivate Property Podcast. This week we've got a really good Q&A. So this has actually come through our team just from a few clients asking around questions around their superannuation, right? And using superannuation to buy property. So the question is, can people use self-managed super or their super to buy property? Which is a fantastic question, right? So what I'm going to do is I'm going to sort of explain this in two different worlds, right? So the first is more so for first home buyers under the first home super savings scheme. The second is more so for investors in like what's known as like a self-managed super fund. So I'll kind of briefly explain both of those and sort of what the differences are and the ins and outs of it, right? So firstly, I'll start off with the first home owner super saver scheme. So basically, a couple of years ago, the government turned around and essentially said to first home buyers that we're going to implement a scheme that allows you to essentially use some of the money that's locked away in your super to help you get yourself and your foot in the door into getting a property, right? Now, I know what I've just said was a very broad statement, right? That's not exactly what they said. Very broad, very general. But I want to sort of explain the intricacies of really what they're essentially doing here and why. So first thing to keep in context, your superannuation is basically the government's way of saying, hey, we know that in the future, with the amount of baby boomers exiting the workforce, there's going to be a certain point in time where we're not going to have enough funding to pay Centrelink. We're not going to be able to pay the pension, right? This is essentially where the idea of superannuation came from in terms of implementing it across the Australian economy. Now, really what it is, it's the government's way of enforcing a law so that the people have to essentially provide their own retirement for themselves, not relying on the government, right? So that's, I guess, kind of the context. Now, obviously, for those who are paying into super and sort of have some problems with it, one of the main issues you've got with super is the fact that A, it's getting locked away until you're 60 years old, right? Right now, it's 60 for people aged under, I believe, I think prior to 1970. I could have that wrong. But the point is like you can't actually access it until you're a lot older. Now, the other issue that comes with it is the fact that time frame or the age that when you can access it is also incrementally getting pushed further and further and further because we've got a growing population. So we're living longer. With medicine, with technology, obviously our overall society, we have, we are living longer lives. So if they were to say, hey, look, yep, everyone can retire at 50 because people were dying at, say, 60 back in the day, obviously, those laws aren't really going to be all that relevant today if people are, still working at 50 because they're not dying until, 85, 90, right? So obviously that means that those timeframes have to keep getting pushed up. But this is part of the problem. Part of the problem is people can't afford to live today. They can't afford, real estate. And I know there is this massive complaint around real estate, the cost, unaffordability, all these kind of terms are sort of floating around. And there is an element where that is true. So the idea is it's a scheme where the government will essentially allow you to dip into it to basically buy your first home and get yourself into the market. However, it's not as simple as that, right? So it's not just as simple as just taking out your super. So in order to do this, you've got to essentially sign yourself up to the FHSS, which is the First Home Super Saver Scheme. Now, the idea is once you've signed up to the scheme, then you can start putting in extra deposits into your super. Now, one of the benefits of that is you're only getting taxed at 15%, right? So instead of having your employer pay you out at, let's just say 37%, they can essentially, you can do things like salary sacrificing straight into your super as an extra contribution, and then it's only going to get taxed at 15% as it goes in, right? Now, this is obviously all from, and I'll give you guys the website. It's on the Australian Tax Office website, First Home Super Saver Scheme. So I would highly recommend all you guys Google that, jump online, you can see what I'm reading from. Now, what happens? Like I said, you can essentially elect to put more contributions into your super. Now, the idea is you can put in a maximum of $15,000 per year or $50,000 across all years. The thing to keep in context, though, you can only pull out what you've put in as extra. So it's not like you can just say have 20 grand in super, sign up to the super saver scheme, and all of a sudden, the following year you can just go and pull out that whole 20 grand. That's not how it works. You're only allowed to pull out what you've contributed as an extra. So that way that you're still meeting your future income requirement in terms of the government, using the pension as the way it's designed. But it allows you to draw out, the extra contributions you've made while you've been signed up to the scheme. So in other words, it's basically a means for people to be able to use their super as a means of kind of locking away their savings, and then they just pull up those extra contributions, they pull it back out, and then you can use it as your property deposit, right? So that's essentially, in a very short nutshell, what the First Home Owner Super Saver Scheme is. Again, I think it's fantastic, especially for those who are struggling to save and put money away. To have it kind of taken straight out of your payslip and locked away, I think it could be a really good thing for a lot of people. Having said that, is it going to solve the world and all the problems? Probably not, right? I mean, obviously, the fact of the matter is prices are still growing. Housing is still unaffordable. We still have huge supply chain issues. And even any time that we're talking about schemes that help first home buyers or help owner occupiers, we're not actually solving the problem, right, in terms of the shortfall supply of housing. And the reason being, one first home buyer comes in and demands one house, and let's just say they go and build a house. Well, they're supplying one house, but they're also demanding one house. So it kind of cancels each other out. Where a lot of the problems will be saved from is essentially helping incentivize supply to the market, supply only. So that's basically investors coming in and buying investment properties, where they're supplying one house and they're not demanding a house, right? Because they're giving that to a renter who is demanding the house. And that's essentially where, again, a lot of the resolutions for our current issues will get fixed kind of long term. Having said that, I think this is a good thing, right? Because, I mean, overall, you've got a system or a scheme implemented to essentially help first-home buyers break into the market. And here's the thing. If using this scheme allows someone to get their foot in the door quicker, that means they can start making money from property sooner. They can use that property to then leverage to buy a second property sooner. Well, this whole thing makes sense. This whole thing works, right? And it's something that I would absolutely highly encourage. However, it's not as simple as what people think. So again, you can only use the extra contributions you've made once you've signed up to the scheme. So like I said, that's option one when it comes to using super in some way, shape or form in terms of buying property with super. Now, the other side of the coin is called a self-managed super fund. Now, this is more so for investing, right? So this is not for a first home. Now, as an investor, what you're basically doing is buying a house, telling the bank, hey, bank, I'm never going to live there. I'm going to put tenants straight into it. So you're essentially doing it like a business. It's designed to make money. That's really, really the intention. Now, you can use your super to purchase direct properties. So that's essentially using your super fund to go and buy houses. You can do that, right? Now, I want to be clear. I'm not a financial advisor, right? I'm a property investment advisor. So all I give advice on personally is the actual property, location, what, why, where, the numbers. This is where the advice needs to come from your financial planner and your accountant, right? So take what I'm about to say with an absolute pinch of salt. I'm going to be very general, very broad in nature. I'm not going to give any sort of specifics or specific advice. Highly encourage you guys to go and speak to your financial planner, speak to your accountant about this to get the actual advice for you in your situation. Having said that, this is generally how it goes. And we've done this multiple times with some clients in the past with our accountants and financial planners. So the client has $500,000 in his super. All right, that's just sitting there investing in shares. The client themselves are pretty indifferent when it comes to investing in shares. In other words, they don't really give a shit, right? So they've got the money in shares. The system's doing what the system's doing. The market's doing what the market's doing. It's kind of out of sight, out of mind. They're not really paying attention to it. So a lot of people that we find who want to invest in property inside their super are people who might want to take more control of your super and how it's invested. They might be people who are more confident in property than, say, shares. There might be people who want to have a bit more control when it comes to, what sort of asset, and why, versus just letting some fund manager on the other side of the world or outside of the country, for that matter, dictate, where they're going to be pushing and pulling different stock prices, right? So again, there's pros and cons to everything. Now, let's just say that client has $500,000, goes and speaks to the financial planner, goes and speaks to their accountant, gets all the advice, and the advice is deemed that they want to open up a self-managed super fund. What basically happens is your super and your financial planner, along with your accountant, will basically open up a trust, and that's going to be inside your new super fund. So generally speaking, they move you to a different super fund that will facilitate a trust and property. So a lot of times what they end up doing is moving you from X super fund today, and they'll move you into a different super fund that's more compliant with buying direct property. Next thing they do is they set up a trust inside the super. Right now, again, the type of trust depends on the accountant, depends on the financial planner. We've seen a lot of clients open up bare trusts, right? And that's just the mechanism that they're basically using. Now, what happens is we transfer all of the money, and it may not be all the money, but we transfer a big lump sum of money into that trust inside the super fund. That super fund then has the ability to go and put a deposit down on a property, assuming that the finance team or a finance broker has assessed the situation in line with buying inside super, and then has worked out your borrowing capacity, pre-approvals, all the finance stuff, so you can actually go and borrow money inside the super. Essentially, what you then go and do is go and buy a property. Now, There are some red tape, and again, it's not just as simple as the way I'm making it, right? It is quite complicated. There are a couple of little rules, or let's just say hurdles, or let's just say red tape that you need to make sure that you're well aware of. So, firstly, because your super is an asset that the government is relying on you to retire, the properties themselves can't be heavily negatively cash flowed. In other words, you've got to either put down a really big deposit on the property, so it's positive cash flow straight away. You've got to be buying a property that's high cash flow in general terms. So what that means is that it's a property that might be worth 600 grand that's paying 800 bucks a week in rent. So that's inherently that's already higher cash flow than the standard norm. So the idea is when you buy it, your super fund is what's buying it. The income that's proved on paper is your contributions that your employer is making into your super fund. And then essentially that's the income, the security you've got, which is already what's inside your super, and that then becomes a deposit for the new property. Another thing to consider as well is you also need to make sure you've got funds left over in surplus inside the trust so that the rent goes in, the repayments come out, and essentially that little lump sum of money on the side is basically the buffer account for the self-managed super. The idea, the property itself needs to pretty much be self-sustaining with your super contributions. Right, so as long as it ticks all those boxes, generally speaking, you're pretty much going to get approved, right? And that's essentially how that would work. So then, you would go in, you'd buy the property, put it in your super, sit on it, put tenants into it, forget about it, and then over the years, you keep doing your reviews, and then essentially, when you've got enough funds, we either keep reinvesting into other forms of assets, whether it's shares or whatever the case, or you save up a second deposit, and then you can go and use that second deposit to then go and buy another property inside your super. One other thing to think about when it comes to this, you can't leverage inside super. So one of the benefits of property is leverage, right? 50 grand can buy a 500 grand asset. But the most important part about leverage with property is property allows you to buy further assets. So you can use your equity from house one to buy a second house. Equity from those two houses to buy shares or buy businesses or buy gold or bonds or whatever. The point is, inside your super, you can't draw out your equity, borrow it, and then go and buy more houses with it. Right, so it's got to be direct cash deposits from your super, from your contributions. So again, like I said, guys, that's a very brief and quick overview of essentially what the differences are between the first homeowner super savings scheme, as well as using your super in a self-managed super fund to go and buy direct property. Now, with all that being said, for those who don't really know much about this stuff, I would encourage you to speak to somebody, like obviously your financial advisor or accountant. Now, again, it's just simply a question to see if it's something that would be worth your time if you are considering doing it. Like I said, there is hoops you got to jump through. Your financial advisor and accountant will be able to give you all that different advice. But fundamentally, you got to make sure it is the right thing for you. You got enough cash, you got enough capital. It has to make sense, right? If it's one of these things where the property you want to buy is extraordinarily risky, it's extraordinarily negatively cash flow. Like the reality is, it's just not going to pass the mark, right? So that's just one thing to keep in context. But like I said, hope that helps.